Thank you for everyone for being here again. So my name is Val. I am one of the organizers of the Bloom program. So we are a program that helps to teach technical women and genderqueer folks blockchain development. So we just started our first cohort. We're almost getting to halfway done with our first cohort, which is amazing. And as a part of that, we do this kind of fireside chat series where we bring people who are currently working in the Web3 industry and have expertise in different areas to talk about that and share their expertise with all of you. So that's it. I'm really excited to have Maggie here with us. So Maggie's the founder of SheFi, and she will tell you all about that. But yeah, thank you again, Maggie, and I will just let you take it away from here.
Hi, everybody. As Val mentioned, my name is Maggie Love. I am the founder of SheFi, and I also am a co-founder and director of business development for a crypto infrastructure project called Web3 Cloud. I've been in this space since 2017, and I'm really excited to talk to you today. I really am a big fan of this program. Thank you, Val, for inviting me. We definitely need more women, especially more technical women in this space. You know, we're building out the future of finance and the future of so many industries, and obviously, women and gender non-binary people. And we really need diversity in order to build the right type of future. I'm super passionate about it. I've been involved in a lot of things. And so SheFi is, one of those ways that I'm hoping to bring more people into the ecosystem. So I'll do a quick introduction and give you a little bit more information about SheFi. We'll go over what's called centralized finance versus decentralized finance. We'll do a closer look at the use cases. And I've picked like 3 that maybe I could try to demo depending on the time. If not, I just shared some screenshots. And then we'll do Q&A. And as always, thank you to Bloom. Thank you to everybody who's here today. And I'm really excited to get started. So what is SheFi? It's a decentralized finance educational program to empower women in the area of decentralized finance through education, experimentation, and community. Sign up to join the waitlist. You can learn more at my website. On Twitter, she__FI, or you could follow me as well. And then Instagram, we're really pushing a lot of content towards Instagram because we think a lot of new people are there. SheFi_crypto. And basically, as I quickly mentioned, I've worked at a couple organizations. I was always on like the community committee for like DE&I work and like how do we bring more people in and policies, and not at my current company, I should say. But in general, I found it's hard to motivate people to implement policies on this stuff if it really doesn't, impact them. And so that like struggle was there. And I was like, you know what? I'm just going to teach women how to use crypto, how to be in this community, how to talk about it, what the mechanics are. I'm going to still try to do DE&I, but I'm tired of trying to influence people, and my time could be better spent just getting more people onboarded into the ecosystem and doing it. And so that kind of passion and that fire, and looking around the consensus office at that time and seeing all men using DeFi and no women, I was like, I have to do something. So when I thought of the name SheFi, I kind of was also like, I really have to do something now. And so basically where we're at right now is I've run 2 public cohorts. So one, I sort of did like a trial one within some of the women at consensus. And then I've run 2 public ones of about 60 women. And we cover basically all the use cases I'm going to go over today. We cover all those topics. And really what I want to do is give women both like the lingo, the understanding, the mechanics, the how-tos for DeFi, and give you like a springboard. And then you can go off, and if you read about another project or hear about more things, you're really able to understand what is being said. Because there's not only crypto lingo, but there's finance lingo, and there's like all these other terms. So I really just want to give you that springboard. And then the community part is really important to me too, making sure we're growing a community of people that are supportive, and there's not really a lot of rules except, there's no bad questions, to be open, to be kind. Like those things are really at the forefront, and you don't have to have a ton of DeFi knowledge. That's what I'm here to do. And I'm just hoping that I excite some of you today to learn more about it and potentially join us. Okay, so really quickly, why DeFi? Building wealth isn't always easy. So decentralized finance, or DeFi, broadens access to wealth building tools and services. So anyone, anywhere with an internet connection and capital can use DeFi. No banks, no KYC, which is know your customer, no approval processes to use DeFi. And so I think the opportunity to build wealth is unprecedented in terms of financial returns and accessibility. And so really though, what SheFi is about growing your financial power and confidence with DeFi tools and services. I'm really big on confidence building. I believe if you believe in yourself that you can take risks and make these decisions and you feel empowered, that's going to be what really moves the needle for people. So decentralized finance. So the queen. So basically, Beyonce's saying here, I encourage you to not forget the power you have or to take it lightly, right? So really what DeFi is the opportunity to become your own bank and your own boss with $2 signs. And so as we know, really quickly, this is the only slide I'll spend on the evolution of where we are to Web 3.0, because I know that Val mentioned you already covered it. But at the left, we start with the very early days of the internet. We kind of see some of this peer-to-peer stuff happening in the early World Wide Web in the 1990s. The Bitcoin white paper, 2008, Ethereum comes live and all the end up purple. We really have the first instance of DeFi in 2017 with like MakerDAO launching a stablecoin. And then it really starts to take off in 2018, 2019. And that's where I was kind of like, oh, I have to start something. And this is just to say we're still at the beginning. And so now is a perfect time to be getting involved. You're still early. So what is DeFi? It's the traditional and not so traditional financial tools and services reimagined in a peer-to-peer framework, right? So reimagined on a blockchain network. And so this slide really shows a lot, like there's so much going on in DeFi. So on the left, we have all these products. On the right, we have total value locked, which this slide is a little bit old. So that value 53 billion is actually probably too small. And then, on the bottom here, we have this Ethereum Lego. So like, what is this thing? Money Legos, what are all these products? Why is billions of dollars being locked up into DeFi? So this is what DeFi is. Here are some of the popular use cases. And I'm going to frame them in towards like what I would want to do as a user with these use cases, right? So for stablecoins, I want a currency that is volatile, so in price that I can easily transact with, right? So Ethereum, Bitcoin, they change price every day. Hopefully you're not looking at it too much, but you need like a dollar currency, right? If you're in the United States, you need the US dollar equaling one to do all of your transactions. So we have the same concept in crypto. Lending and borrowing, I want to earn interest, so additional money on my crypto or take out a loan without an intermediary or complex terms. Exchanges, I want to easily trade between multiple currencies and tokens. Derivatives, I want exposure to the value and performance of an asset without holding that asset. Insurance, I want protection for my assets, so if a negative event happens, I do not lose a significant amount of money. Governance, I want to be part of a community that has a say in the decisions that influence a project's roadmap. NFTs, digital art, I want to mint or purchase a digital good that is provably unique. Liquidity providing, I want to provide a platform with capital to earn additional financial rewards. And indexes, I want to own a basket of multiple tokens to get exposure to all of the potential upside and variety of DeFi or NFT projects. Right. So this is the state of DeFi use cases today, and it's always growing. Okay. And so why am I passionate about DeFi? Because with DeFi, we are breaking down the barriers of banking and the walls of Wall Street. Governance and banks cannot restrict or regulate your assets or access to DeFi. That is definitely not as true anymore, especially if you've been paying attention with what's been going on in the United States. There's actually a lot of activity around how do we regulate DeFi, hopefully towards good regulation. But in general, they can't, restrict your access to these tools and services. So financial services that were only for a certain class are now for all, right? There's no accreditation status. There is no, you had to go work at Goldman Sachs. There's no, boys club, this, that. So it's really for anybody in the world to participate. And to me, that's just incredibly powerful and can really change people's lives. So you don't need a large amount of wealth to grow your wealth, right? So in the traditional stock market, it's hard to buy Apple today because it's at some hundreds of dollars. And so you would need to actually buy a whole share, right? With crypto, you can buy small amounts of ETH, of Bitcoin, of stable coins, and you can start using these things in DeFi platforms and products. And so the future of money is digital, programmable, and unstoppable. This is something that you've definitely already heard throughout this program. I truly believe this. I see it every day. I live and breathe it 24/7. This is the future of finance. So it's really important that women start getting exposure and accessing it now. So as always, when I give this presentation, there's this idea of Ethereum money Legos, which is basically like all these products and use cases I'm going to go over actually can link together because they're all built on the Ethereum blockchain, right? So then when you're linking a bunch of products together, there are risks inherent with doing it. There's risks with investing your money anywhere, whether it's the stock market, whether you're on Wall Street bets to highlight something a little bit more silly, or this whole crypto asset class is new. So be aware of that when you're using the projects. There's things you can look for. Have they had a smart contract audit? Who are they backed by? Does the team exist? Is there a Twitter? Is there social media presence? Is there volume on the platform? So there's ways to de-risk, but think about anything you do in crypto still as how much money are you willing to put in, because it's how much money you're willing to use. So DeFi is great. It's incredible. It is risky, just as many things can potentially be. So I just want to make sure that we're all aware of that before, I tell you to use DeFi and you put your money and you lose it. Just be careful with it in case you do. So really quickly, when we talk about crypto platforms, there's actually centralized finance crypto platforms and decentralized finance ones. And what's better than a dance battle to show you what the difference is? So centralized finance, or CeFi, are crypto products, platforms, and applications that are operated and managed by a centralized organization. They are not built on a blockchain, even if they offer access to crypto assets. They require know your customer and other onboarding approval things. So that's verifying your license, your passport, connecting to banks, all that stuff. And they custody, which means they hold your assets for you. So you need permission to withdraw your assets. There's still a human in between you and your assets, and they're hosting all the technology to manage your crypto. You're not. So examples, of this are some of the exchanges. So Gemini, Binance, Coinbase, right? So they're actually centralized finance, even though they offer access to crypto. Decentralized finance, so crypto protocols, products, and applications that are run by code. They are built on a blockchain. Know your customer is not required. They're non-custodial, so they do not hold your assets for you. And so there's decentralized governance and management of the platform. So many of the platforms are still centrally managed, but they're working towards this decentralized governance, the community that owns part of the platform tokens to make decisions about it. And so I think the biggest thing is these are actually built on top of blockchains like Ethereum. And once the code is deployed, it can't be changed by a middleman, and you can freely move in and out of it with your assets. Versus centralized finance, an organization and humans are behind everything happening there. So examples of each. So centralized finance on the left, we have Coinbase, BlockFi, Gemini, PayPal, who offers access to crypto, right? So still centralized. And so on the right-hand side, we have DeFi, which is MakerDAO, Uniswap, Aave, Open, Argent, Compound. And so basically what I like to say is on the left, you're trusting the company, and on the right, you're trusting the code. Okay, so we're going to go into some of these deep use cases, a little bit diving deeper, and that's Anderson .Paak diving into a money pool. So stablecoins, solving for volatility, right? So the cryptocurrency vision is to replace fiat globally as everyday currency, but the problem is that cryptocurrency prices are volatile. Our everyday transactions require the value of the US dollar, if you're in the United States, or any fiat currency to be stable. So just like the traditional economy, the digital economy also needs stable money. Enter stablecoins. So stablecoins are tokens that are pegged one-to-one to other stable assets. So what pegging is it's fixing an exchange rate of one currency to the value of another currency. As you know, if you travel between countries, you have to that exchange rate is applied to how much you get for US dollars if you go to Canada or somewhere else in the world. So a lot of stablecoins are pegged one-to-one to the US dollar. Some examples are DAI and USDC. So one DAI equals one US dollar and one USDC equals one US dollar. Yet not all stablecoins deploy the same mechanisms for pegging. So DAI is a decentralized crypto collateralized stablecoin. So everything that's keeping DAI equal to one US dollar, it's all backed by other cryptocurrencies, and it's decentralized. So that exists all on the blockchain. In contrast, USDC is a centralized fiat collateralized stablecoin. So USDC is backed by actual $1 bills, US dollars, in reserves, in banks or somewhere else. So USDC, when it's minted, it's a dollar is locked up. DAI is all by people locking up crypto in a different type of method. So that's just to say that, not all stablecoins deploy the same methods for keeping that $1 peg. And so what solving for stablecoins, solving for volatility allows for many financial possibilities: payments, trading, savings, loans, insurance. And so stablecoins are money, and to be money, it has to be a medium of exchange, a store of value, and a unit of account. So stablecoins, by equaling, $1 or being pegged to some type of stable asset that's accepted by money, they meet that criteria. The next use case is lending and borrowing, so putting idle crypto to use. So a problem is, after purchasing crypto, this used to be a problem, I should say, you couldn't do much with it except hold it until you're ready to sell. So you'd purchase ETH, and then you'd wait for the price to go up and you would sell. So really there wasn't much you could do with those cryptocurrencies. So a solution to that, what Compound was the first player to do this, but there's other lending and borrowing platforms. They figured they should let people earn interest, so additional money on their crypto, by creating a money market for people to lend and borrow. So they came up with this idea: if we let people deposit their money somewhere, they can earn interest because people will want to borrow that crypto to use it in other places. So lending platforms are decentralized money markets. So what you can do on them is you can lend crypto to earn interest. Right? When you lend money, it allows others to borrow it. You can borrow crypto to use elsewhere. When you borrow money, you pay interest on it, right? So interest rates are a charge for borrowing money, or the price of money. And so something important to note about lending platforms is they're a bit different than just, me going to Val and asking her for money and agreeing to some terms on it. So they do lending and borrowing via liquidity pools. So a liquidity pool allows users to lend and borrow from a smart contract that pools liquidity, not other users, right? So you're actually depositing money into a pool and you're borrowing money from a pool of like crypto tokens. And so what does that do? It cuts out negotiating with a counterparty, and it cuts out the middlemen. This means that the protocols on these lending and borrowing protocols have a high amount of liquidity, so a lot of capital, because it's really easy to deposit and borrow against these pools. So these pools determine interest rates algorithmically based on supply and demand, right? So it's not this cutting out, maybe getting an opaque or understanding of like why you're paying a certain interest rate because you're going to another person in the traditional financial world. And so a lender can withdraw their funds from the protocol at any time. So there's none of these lockup periods. So really this allows for permissionless, seamless, efficient lending and borrowing, where you as the user have all the details up front and you know everything you need to know about the loan. And then it's also not doing any other discriminatory practices based on who you are as a lender, because there's no middlemen, there's no like lengthy process, there's no subjectivity in that process. And so why lend my money to a DeFi protocol? Your idle crypto is earning 0% interest. Your fiat sitting in your bank account is earning 0% interest as well. Chase Bank, where I bank, the interest rate is 0.01 or something smaller. And so really lending and a lot of these other protocols are about putting your money to work. Something you should take away from this is with DeFi, you can always put your crypto to work. It can always be earning money for you, which is pretty exciting. So lending and depositing assets into Aave, which is a lending and borrowing platform. So to lend an asset, you must have that asset in your Web3 wallet. So you have to have some crypto in a Web3 wallet like MetaMask in order to do this. You'll pick from a list of assets, which will take you to that asset's dashboard. You'll click deposit on that asset's dashboard. And the first time you deposit an asset, you'll require additional approval transaction, but then you can. So I have this like screenshot of the Aave platform. There's some DAI, USDC. They also have ETH. They have a lot of other digital currencies. And, I want to deposit some USDC. So I'm going to click on that. And then there's a deposit button. And so there's some balances there. And, once I've deposited, I can actually borrow. So it's really simple. You literally connect your Web3 wallet with the asset that you want to deposit into Aave to earn that APY, the interest rate. And then you like have a few more clicks and then you're done. So when you borrow and repaying a loan on Aave, so once you've deposited collateral, you can choose an asset to borrow against it. You pick an asset and you select borrow. It's that simple. So, on repaying to get your money out, on the borrowing dashboard, select repay and the amount you want to repay. So you have to make sure you have the full amount of the loan plus the interest, as well as some ETH for the transaction, because as you know, ETH is like the gas for the Ethereum network. So you pay a little ETH with every transaction. And also you can now repay loans with the collateral you originally deposited. So they're coming up with more and more ways to make this a very frictionless process for borrowers. So basically you click borrow, and when you want to hit repay, you click repay, and you have to have the money to repay it. So it's really that simple. And so now we're going to talk about exchanges. So exchanges are venues to exchange, buy, and or sell crypto. So you have centralized exchanges, operates via a single entity using their own software and system to match buy and sell orders, so to match trades. And decentralized exchanges operate without central authority via smart contracts. So both types of exchanges provide access to digital assets. Right. So we kind of went over this. Centralized exchanges operate and managed by a central organization, not built on a blockchain, require to know your customer, custody your assets. Decentralized exchanges run by code, built on blockchain, don't require to know your customer, don't hold your assets for you, and they're run by decentralized governance. So some pros and cons, or I tried to reframe it as pros and risks. So centralized exchanges, pros, you're not managing your keys. So you're not really, if you lose your seed phrase or if something happens to your wallet, you don't have to worry about any of that with a centralized exchange because they do all that for you. You won't even see your keys or that seed phrase. It's really easy to exchange fiat for crypto. So with decentralized exchanges, it's not that easy to necessarily, purchase crypto with a credit card. So really centralized exchanges are great on-ramps for getting that first crypto. Ones like Coinbase, and I'm sure others, are FDIC insured. So you might not get your crypto back if something happens, but you'll get the US dollar equivalent. And they have customer service teams, there's accountability, there's all of that. The risks is there's a single point of attack, right? There's this honeypot of money sitting on centralized servers. In crypto, if it's not your keys, it's not your crypto. So if you're not managing your wallet, if you're not managing your funds, at the end of the day, whoever has access to those keys really controls your funds, and that's not you. There is know your customer, and so they are for profit, so there's likely higher fees. Examples: Gemini, Kraken, Binance, Coinbase. Decentralized exchanges, so user owns the assets. There's no single point of failure because it's built on a blockchain, so it inherits all those properties of a blockchain. There's lower fees. Well, that being said, when Ethereum gas prices, when the Ethereum transaction fees are really high, the fees can be high, but inherently in the platform, they are lower. There's no know your customer, and decentralized exchanges can't be shut down, right? So centralized exchanges still report to the governing bodies of wherever they operate, and they can be shut down. Decentralized exchanges run on a blockchain. They cannot be shut down. The blockchain operates 24/7. And at the moment, it does not adhere to any single one locality. And we haven't seen any impacts of governing locality, putting restrictions on it. I still don't think it could be shut down though. So some risks, the user must manage her own keys. There's low client support on these decentralized exchanges. So there's nobody to call up if you don't make a transaction correctly. And so any assets can be listed on these decentralized exchanges. And what I mean is when you go to Coinbase or Gemini, you'll maybe see 10 to 15 assets, maybe more. And that company that wanted their token on that platform had to go through a whole process to get it there. Whereas with decentralized exchanges like Uniswap, I could launch the Maggie Love token tomorrow and try to get some liquidity and just put it on there. And then if you went to trade for it, like you could, but that doesn't necessarily mean that the Maggie Love project is the greatest project in the world, or that there's a lot of liquidity, or that it has all the benefits, or anything's behind it. So you as the user just have to be more aware of the tokens you're swapping in and out from, because the list can be very long and not all tokens are created equal. Where more likely on centralized exchanges going through that process, you're only going to be shown ones that have like significant backing in some way, or the platform actually exists. Examples of decentralized exchanges: Uniswap, DYDX, MetaMask swaps, 1inch, and Bancor. And so really quickly, I wanted to show it's super easy to swap on Uniswap. So you'd go to uniswap.org/swap. So then if you kind of look at the right-hand side here, there's really, the interface is just this one box. And there'll be a box for you to enter tokens to swap. So select a token that you want to swap from, that's the top. And then you want to select a token that you want to swap for, which is the bottom gray box. And you enter the amounts and then you swap. So just like 2 screenshots, you'll see there's ETH with a little drop down. So you could actually change that token if you want to swap for something else. And then you have a select a token that you'd want to swap for. You put the amounts in either top or the bottom. It automatically populates whatever the equal is, if you want to trade some ETH for DAI, et cetera, or USDC for ETH. And then, once you populate those fields, it'll show you some of the numbers, and then you click swap. It's that simple. It's a really clean and easy to use interface. And so moving on to the next use case, there's derivatives. So a derivative is a contract that derives its value from the performance of an underlying entity or a group of entities. And by entity, we mean an asset, an index, or an interest rate. So there's different types of derivatives. There's futures, there's options, there's swaps. And these different types serve different purposes. So maybe you're hedging against a volatile or underlying asset, you're speculating on the performance of an asset, you're leveraging holdings. I want to say that derivatives require more expertise. I wouldn't say that your first DeFi use case, if you've not done anything in DeFi, should be all of a sudden becoming a derivatives trader. But the point is that, you know, with DeFi, we can take a lot of these traditional financial tools like derivatives and mirror them on the blockchain, and the properties of blockchain make them more accessible and are more transparent, like all these great things. So another type of derivative is synthetics. So they give, once again, trader an exposure to an underlying asset like gold without her having to own that asset, gold, right? So the idea is that you can frictionlessly trade for any other synthetic asset, and you don't have to go through a middleman. So you can trade on the performance of gold without owning gold bars. And now you can do this with a crypto version of it. So types of assets or groups of assets you can get exposure to through crypto synthetics on this platform called Synthetics are cryptocurrencies. So Bitcoin, Ethereum, commodities, gold, silver, fiat currencies, US dollar, Japanese yen, indexes, like, you know, the centralized exchanges in DeFi, those are indexes. So they hold tokens that represent those platforms, multiple ones, like an index fund. So basically the idea is if you want to trade on the price of Ethereum and you don't want to hold Ethereum, if you want to trade on the, you know, upside of gold but not hold gold, you can use these assets that represent it. And once again, just a reminder, crypto and DeFi can be risky for users. There's financial risks, so asset prices are volatile and that can create liquidity risks. Technical smart contract bugs that can be hacked can cause an entire system to be vulnerable. This is an old hack, but there's probably like a hack, I don't know, every 2 to 3 weeks, maybe monthly in the DeFi world. So, you know, the BZX hack lost about 1 million. There's a really large one the other week. And so this is just, you know, smart contracts are not always perfect. And in the DeFi space, we are seeing sometimes people just kind of chasing this gold rush. And so they'll launch their platform without it being audited, and then someone will hack it. A lot of times these are white hat hackers, so they actually return the funds. But this is just, especially like speaking to a technical audience, things to be mindful of when we're dealing with new technology. Centralization. So centrally held admin keys can be compromised. So some of these DeFi platforms actually still have these centrally held admin keys, which are kind of like, you know, that ultimate power key. So they can ultimately shut it down or ultimately control some part of it, which is not decentralized at all. And so regulatory, there's a gray area. Some projects may be non-compliant. We're dealing with a lot of this in the US. I'm watching it closely. And so if a platform is risky, the good news is you can buy insurance, right? So buying insurance can protect you from a variety of risks. Right now, there's 2 different types of insurance out there, main insurance products, covers and options. Covers built by Nexus Mutual. So you can buy coverage against a smart contract risk, a bug or event. So a user specifies the smart contract that she wants to buy this cover for, the time period, and the amount of value she wants coverage for. So if there is a smart contract failure, so a technical bug, claims assessment happens by an assessor, and once approved, she gets paid the amount specified. So that's one type of insurance product. Another type is options by Opyn, OPYN. It's a financial derivative that a user buys to protect against both technical and financial risks. So Nexus Mutual is really focused on the technical risks in DeFi, and Opyn is financial and technical. So 2 types, there's a call, the right but not the obligation to purchase a specific asset at a price within a specific time period. Put, the right but not the obligation to sell a specific asset at a set price within a specific time period. So you set those parameters, right? And then a user is basically with an option buying the right to decide if she wants to buy or sell something in the future. And so this would be to like hedge different price points or things like that. If you think that the price of ETH is going to have a crazy crash, you might want to, you know, buy a put. And so you would sell it at a certain price if it gets to that, but you sell it right then, and then you don't burden the risk of it going any lower and selling it for even lower. So for every purchaser of an option, there must be a seller of it, right? So it's this 2-sided market for these different types of insurance. Okay, and I always like to include NFTs, even though we're more focused on DeFi. So NFTs, what do you own in a Web 2.0 world? And really, I do think NFTs, they relate to DeFi really well. There's actually a whole collaboration point between NFTs and DeFi. And basically everything in crypto sort of turns into a financial instrument, a new way to own things. So in a lot of ways, everything kind of becomes financial in a Web 3.0 world, for better or for worse. So in Web 2.0, so digital assets in current Web 2.0 platforms are not yours, including your social media handles, your Instagram and Facebook posts, photos, your in-game items if you're a gamer, characters, costumes, weapons, levels, etc., event tickets, domain names. So, I have www.shefi.org, which I have to repurchase from Google every year. And so these platforms ultimately own them, right? So if you try to sell your Instagram handle, gaming skin on eBay, you'll realize that you can't do it, as they belong to those gaming platforms, as they belong to Instagram. So what are NFTs? Non-fungible tokens. So NFTs are a special type of Ethereum. This is on Ethereum token called ERC-721. So what an NFT means is every token is distinguishable from another with a provable owner. So therefore, in order to track these tokens, you must track each token and owner separately. These NFT tokens are used to represent digital or physical assets with unique properties. So physical property, digital art, virtual collectibles, negative value assets. If you name it, there's probably a way to make an NFT out of it. And so NFTs allow for the incorporation of metadata for descriptive information about the token. So with ERC20 tokens like Ethereum, you can't incorporate this metadata, and you don't necessarily need a unique provable owner. But with NFTs, these type of tokens, you do. So just on the bottom here, I want to go over some NFTs that I have represented. So on the bottom left is a parcel of land in a metaverse called Crypto Voxels that was purchased, and my friend built this. It's called Inuchima, but it's based on Inujima in Tokyo, Japan. So he built this, and as somebody in Crypto Voxels, I can go and look around at it. If he wants to sell this piece of land, like, he owns it. So there's no like paying off to own this piece of metaverse. He owns it right away, and he can sell it to the next person. CryptoPunks, wow, they just never seem to lose their incredible power in the crypto NFT ecosystem. Visa just bought a CryptoPunk. So, right, you own this really rare digital collectible that we have memed into having a lot of value. And then over here, I have SheFi.eth. So that's my Ethereum name for my SheFi wallet, where I keep all the funds for SheFi. So unlike www.shefi.org, I own this ENS name, this Ethereum name, and I can sell it. Then we have, NFT.energy was something the group Disclosure put out. So a piece of music, and then CryptoKitties, which is kind of like the first NFT that really blew up in 2018 and was one of the first reasons the Ethereum network got super congested. So why are NFTs really important? And so they change digital ownership, rights, and distribution. So blockchains enable common, reusable, and inheritable standards relevant to all NFTs. These include basic primitives such as ownership, transfer, and simple access control. Blockchains are a coordination layer for digital assets that empowers users, not platforms. And now you own domains, social media handles, arts, gaming gear, and you can sell them on marketplaces to anyone globally, moving ownership and management of assets from platforms to you. Same with DeFi. All of everything that I'm talking about today is this idea of moving power from middlemen, from platforms, from centralized entities to you. And so if you wanted to buy an NFT on Zora, you'd go to zora.co. You would link your MetaMask and make a profile. You could look through a collection of art. Once you find a piece of art you like, you place a bid, you enter the amount you want to bid, and you place your bid, and it's an auction model. So you'll be notified if you're the highest bidder. Then it's the NFT is now yours and only yours. And keeping it simple, NFTs are provably unique digital assets issued on blockchains and therefore cannot be copied, destroyed, stolen, or frauded. Okay, summary, getting started, Q&A. Since this is DeFi, Rihanna making the symbols of money. She's a very powerful and incredible inspiration in that way. Summary. DeFi is the traditional and not so traditional financial tools and services reimagined in a peer-to-peer framework. These financial tools and services include stablecoins, lending, borrowing, trading, derivatives, insurance, NFTs, etc. They're built on a blockchain, means these protocols are decentralized, transparent, permissionless, censorship resistant, and programmable. And DeFi allows users to access financial tools and services traditionally hidden behind bank approvals and provides new opportunities to generate wealth globally. Use cases, once again, stablecoins, lending, borrowing, exchanges, derivatives, insurance, governance, NFTs, digital art, liquidity, providing indexes. And we didn't go through all of these today. We have limited time. I wanted to make sure we had time for questions. And this list is always growing, and people are always thinking of new things to build in the crypto financial ecosystem. And right, with DeFi, we are breaking down the barriers of banking and the walls of Wall Street. Governments and banks cannot restrict or regulate your assets or access to DeFi. I should definitely update that bullet because they can, they just haven't really yet stepped in that way. Financial services that were only for a certain class are now for all. You don't need a large amount of wealth to grow your wealth, and the future of money is digital, programmable, and unstoppable. And so imagine a global open alternative to every financial service you use today: savings, loans, trading, insurance, and more, accessible to anyone in the world with a smartphone and an internet connection. Like, that is so powerful to me. And so I just want to say thank you. Once again, my name is Maggie Love, founder of SheFi. I also co-founded and work at a company called Web3 Cloud. Once again, please follow us on Instagram. Instagram is where I really try to break down topics and use graphics and let you learn a little bit more about them. And SheFi also highlight women in the ecosystem. That could be you. If you're interested, I can share the link where you can put in some information. Follow me on Twitter, on the SheFi Twitter. And I really love this quote. And I think this is really how I hope I'm approaching what I'm doing with SheFi. So it's just, don't stand for the success of other women, insist on it. And really, I think about doing something about it, which is why I'm doing SheFi, and why I really commend Val and the other founders of Bloom about like doing things to make sure that more of us have a spot at the table. So now I'll open it for questions, or if people want to see a demo of Aave, you just let me know, and we can go from there.
Thanks so much. This is amazing. So there are some questions in the chat. So Aaron asked if you can talk about folks transitioning from tokens to DAOs, as an example, Shapeshift.
Yes. Okay. So I'm not incredibly familiar with the Shapeshift organization, but I will say I debated adding DAOs to this as well. Like, the list keeps growing. I am researching a lot about DAOs because they're really popular for all types of use cases. Investment DAOs, so that's just like a group of people coming together to manage a pot of capital and invest it in other crypto projects. A really cool one is Como Rebi, which is investing in female and non-binary crypto founders. You should definitely be looking at that link. Like, I'm a backer of it, but then 5 people actually bring the projects to us. We all vote on it. So there's examples of those types of DAOs. There's DeFi DAOs, one called Badger DAO, which has interesting ways. Our Yearn.finance is a crypto yield generating, interest earning platform that also has a DAO that manages it. There's DAOs like Shapeshift, and MakerDAO is a true DAO now. So DAO stands for, Decentralized Autonomous Organization. Autonomous is the word that some people have friction with, right? Because there's still humans involved in all these decentralized organizations, but it's about moving the decision-making of a project's roadmap, of how funds are allocated, of how anything's coordinated from a small group of people to many people. And what Shapeshift did is they allowed everyone that holds their tokens to start managing different parts of the future of Shapeshift. So the CEO and founder, is his name Eric? It's slipping my brain, but basically the Shapeshift core organization and team is now not responsible for how that exchange works. A group of many people who hold tokens now determine it. So what DAOs are is they're trying to give people these tokens that have value, that also give you voting power. Tokens are not the only way to do decentralized governance. It's the most popular way at the moment. But the idea is like, you own Shapeshift token and you want that token, you care about the project, you're a user of Shapeshift. So that's the first thing. If you use Shapeshift, you got airdropped the token, because the idea is empowering the users and the community of that platform, not just people who have money to invest in the platform. So that's a big part of DAOs too. Rewarding the community, giving the community this token that they hope to increase in value. And because of that, you're also incentivized to vote on it. So it's just this idea of how do we empower communities and invested communities by using platforms, by contributing code to it, by in a way, people that engage with the platform, this decision-making power, instead of either a single organization or just people that have invested in it. So it's kind of like flipping this idea that you need investors in a way to determine the future of your platform like communities can. And I think that's like the most exciting part for me. Like, let's disrupt Silicon Valley. And the people there making all the decisions about what is cool and important tech. Let's like let people who care about something start a DAO and incentivize other people who care about it and who are interested and want to make an impact on it, and give them both like this financial token and this ability to vote. I think is incredibly powerful, and I'm super excited about DAOs. So hopefully not too complex of a way, but like Shapeshift is one of the first big organizations like MakerDAO as well to say, hey, let's stop having Shapeshift team make all of the decisions. Let's empower the people who've been using Shapeshift to have these tokens and make decisions.
Great. Dan had a question, which is, can you explain how we might move from centralized platforms to decentralized platforms? So as an example, moving crypto from Coinbase to something like Uniswap.
Great question. And so Val had mentioned you guys had went over different types of wallets. So you know, like I said, Coinbase is a great on-ramp. And then you have a MetaMask wallet as well, right? Or you have some type of wallet that holds Ethereum tokens, if we're using Ether as an example. So you take your Coinbase Ethereum and you have a wallet there, right there holding that wallet, but you can still send crypto to and from it. And then you have your MetaMask wallet, which you completely control, and you copy that public address from your MetaMask wallet into Coinbase and you say, send the funds here. Once your money is in MetaMask, you can use any Web3 project. So wallets like MetaMask are Web3 wallets that are like your single login to everything Web3. So you don't need, like right now, if I have Gemini, Coinbase, and Kraken and Binance, let's say I have a bunch of centralized exchange accounts. I have a password and email for this, a password and email for this, like for each centralized platform. With DeFi and crypto Web3 platforms, you log into your MetaMask and then you're like browsing the Web3 web. So I can use my tokens in Uniswap. I can go to Aave. There's no logging in a bunch of times. And so that's one thing. And then once my tokens are in MetaMask, I go into Aave, I quickly connect my wallet, and then I start using it. So crypto wallets are great. They're your like single login for everything Web3. And then they're also your ways to start using these platforms. So you need a Web3 wallet like a MetaMask, Argent, one called Dharma. I can also send some lists of these. And so you can start then putting your funds into these projects because they're in that Web3 wallet. You can't access like Aave from Coinbase. Coinbase has its own digital wallet. So that might've been an interesting example, but you should really put it in like a Web3 enabled true mobile wallet, not from like a centralized exchange platform.
Yeah, that's really helpful information. So another question from Aaron was, what's a good example, if you know any, of a decentralized form of events platform, like something like a decentralized Eventbrite?
So I don't know if I've heard of any yet, Val. I don't know if you have either. I guess, okay, so when you attend crypto events, there's things called proof of attendance POAP. So there's ways to like prove that you attended, which I think people are focusing on first. Like, let's reward people for showing up. And maybe we don't have like an NFT yet or some other way, but we have a way to prove that they were there. And therefore they can always like, you can show that you've been to like all of the Bloom events. And then like, maybe there's something you get from that, or proving that you showed up is a way. But there's no like truly, I think there's attempts at it. It just hasn't been perfect yet, but there are ways where you can like scan QR codes and show something in your wallet that like an NFT that like you're attending ETH Denver or you're attending some other crypto event, but there's no true like decentralized events platform. But I can also like take the note to kind of look around. They just haven't been top of mind. Top of mind have been like NFTs, DAOs, DeFi. So it hasn't been on my radar as much.
Yeah, I don't know of any myself as well, but yeah, those are great examples of how people are attempting to kind of meet that space. Okay, so another question from Aaron. What determines the amount of money or the amount for any of the lending platforms for loans in crypto? Can you break down what I put in as collateral, if any, and what I can expect to get out? So on some of these platforms like Aave and Uniswap.
Yeah, great question. So basically, like I mentioned, when you're depositing into Aave, first of all, you can only deposit what you have in your wallet. So that's ETH, USDC, DAI stablecoin. If you have Aave tokens, I don't know if you can deposit Aave tokens on Aave, but basically you can, let me just pull it up actually. So we can kind of just like take a look at like, what can you deposit in there? Okay, so right now this total market, that's Aave on Polygon. So Aave V2, there's, gosh, a large amount of money in there. So DAI, you can deposit DAI, Gemini, US dollar. So Gemini has its own stable coin, which is very similar to USDC. They're both backed by US dollars locked up somewhere. Same with Tether, Ethereum, wrapped Bitcoin, which is a version of a Bitcoin on the Ethereum blockchain. Binance, Ethereum, BUSD, also stablecoin, Aave tokens, you can, Ampleforth, basic attention, balancer curve, DeFi. So like, look at all these, you can, any of these tokens you have in your wallet, you can deposit. So that's really your option for that. And you see your deposit APYs, they're not super high right now. Sometimes they go up and down because it's all based on like how much there actually is in the pool. Deposit APYs, which you're going to earn on interest, and borrow APYs, which you're going to pay if you borrow, right? So let's say USDC. Okay, so here's an example. Total borrowed, you can see right here in this middle section is how much money's been borrowed, and total availables in green. Look at how small that available liquidity is. So basically there's, that ratio of how much is borrowed versus how much is in the actual, and this is like the example of the money pool, right? So I'm not waiting for, I'm not saying I want to lend USDC to Val, and then we're going through all these negotiations. I'm depositing into a pool of USDC. A smart contract is a pool of USDC. It's holding this USDC, and I'm depositing into that smart contract. And then if I want to borrow, I'm borrowing against that smart contract. And that smart contract has this equation, right? So it's all based on the percentage of how much is outstanding and how much is available to borrow. So if there's a lot of liquidity in there, there's probably going to be lower interest rates to deposit, right? And if there's like not a lot of liquidity, they're going to want to attract more. So they increase the interest rate. So it's kind of based on like supply, demand, algorithmically determined. So that's really how it works. And there's a different smart contract holding DAI. There's a different smart contract holding different tokens, right? So each smart contract holds these pool of tokens, and you're going in and out of this pool, which means you're not negotiating any specific terms on lockup periods and all that stuff. You're just moving in and out when you want to. You can lend for 5 minutes, you can lend for 5 years. So that's kind of how that works.
Jolene brought up a really good point and asked if you would chat a little bit about this. So I guess one critique kind of in the space of DeFi is that as you move trust from a company to trust in code, it's like you kind of require a different kind of privilege. So people who are not technical enough to understand the code and like analyze smart contracts, they wouldn't have the ability to necessarily put their trust into that. And so maybe they are just left with the choice of going with a more centralized solution where they would trust a company and regulation instead. Can you talk about your opinion of that, and then like just what some of those trade-offs are when it comes to giving access to people who maybe don't have a technical background or a financial background and are trying to make the decision of which route to go?
Yeah, so definitely helps if you can read smart contract code to know what is safe. So I'll say, but there are like other identifiers, right? So you can see if they've had smart contract audits and who they've been audited by. So Consensus Diligence is a big platform, I think Trail of Bits. So if a platform doesn't have any smart contract audits, you don't even need to be a technical person to know, I probably shouldn't put my money in there, right? And you don't need to be technical to see if they've had some audits that, oh, this team cares about their security and has like invested in this. So I'd say that's one. Another is like maybe not how much money's in there is a good idea, because people will take those very risky opportunities if they have money to lose, and they'll just be like, okay, I know it's not audited, I know it's a brand new project, but like I'm going to get 1,000%, returns on my money, and that's okay. But you can look at if it's been audited. Once again, I said, look at does their website look like it's been built properly? Is the interface easy or is it not? Some things that might sound silly but are important, like do they have a Twitter, and does their Twitter have a following? Do they have any investors? Do they have any people that have backed the project? Is there other crypto projects that back it? But really, there's kind of this idea of like blue chip projects that's like Aave, Uniswap, MakerDAO. Any of these like other Compound, Balancer. I mean, there's tons of platforms out there that have been around for a long time. They have a lot of liquidity. They're written about on different DeFi websites. They have huge presences. They have Discords. Discord's really important. Do they have a Discord? Do they have a way they're engaging with their community is basically what that means. Are they answering questions? I mentioned that like not always centralized platforms have like customer service reps, but they have Discords, right? And you can go in that Discord and you can like ask questions and somebody will usually respond. They have FAQs, they have a lot of things. They can't necessarily go get your funds if you send it to the wrong person, but they're there to like answer questions. So have they been audited? Do they have Discord? Do they have a real working website? Do they have social media? Twitter, not really Instagram. That's just something I do for like education, but I wouldn't say that's something you should look for. Everything in crypto is basically Twitter. And then kind of like, if are there any big backers of it? Because, hope, investors wouldn't just invest in like anything. So there's different things you can do from like more of a qualitative perspective. And yeah, so you might want to go with the centralized platform because you're not too sure about DeFi, but then again, you're relying on like the cybersecurity practices of these centralized platforms to also protect your money and like not lose your keys. Like this doesn't happen in Coinbase, but like pretty sure like a Turkish exchange, like the CEO just like disappeared. Like you'll hear every once in a while, like an exchange, like CEO just like disappearing. So like, that's something you always have to worry about as well. So do what you feel most comfortable with. My whole thing with SheFi is not to tell women you should use these platforms. I want to give you everything, like how to understand them. And then like you can determine based on your own risk appetite what you want to use. If a centralized platform is more comfortable for you, like totally use it. But I think once you like see the potential of DeFi, like someone at the beginning of SheFi are like, I just want access to ETH. I'm just gonna like buy on Robinhood. And then like I'm demoing and they're like, oh wait, I can't use Robinhood with this DeFi project, or like I can't buy an NFT, or I can't, get an index token. And then immediately they're like, okay, I need to either like go on Coinbase, start there, get my money out of there. Like DeFi kind of sells itself. And like, I think we are in a world where people are comfortable with like being responsible for, their money. I think we're moving towards that. It's not incredibly difficult. And young people especially are just like, for sure, like I've been using a phone since I was 2 years old. So like I can manage my own keys, stuff like that. But yeah, those are some of the other checklists you can have in your head if you can't like read the code.
Cool. Well, that basically brings us to the end of our time together. Again, Maggie, thank you so much. This was really awesome. And for everyone joining, thank you for being here. So yeah, thanks again, Maggie, and we'll see everyone later.
Yeah, thank you guys. Bring more incredible people into crypto. People are always asking me for, how do I hire more women? How do I hire more people? So hopefully between Val and I, we're getting, and the other founders of Bloom, we're doing that. I'm always happy to share job things too. Val, I can shoot you over like the job board that I keep track of.
Yeah, that'd be great.
And yeah, like I hope you just keep at it and we make this a more diverse community. So thank you all for participating in this program as well and having me speak to you.
Yeah, thanks. All right, bye everyone.